There's a moment, and I think a lot of us have had it, where you're sitting at your kitchen table or maybe you're lying in bed at night and you're doing the math in your head. The quiet, slightly terrifying math. You're thinking about how old you are right now, how much you have saved, how much you probably should have saved by this point, and something in your chest just kind of tightens. It's not panic exactly. It's more like a slow, low hum of worry that follows you through your day, through your commute, through your lunch break, through the moments when you're supposed to be present, but you're actually just quietly running numbers in your head and coming up short every time. And the cruel thing, the internet doesn't make it better. You look up how much should I have saved by 40 and suddenly you're reading about people who retired at 35, who have index funds worth more than your apartment building, who started at 22 with perfect discipline and a Roth IRA and a spreadsheet that their future self is now thanking them for. And you think, okay, that's not me. That was never me. So now what? What if the answer isn't to catch up? What if the answer is simply to start and to start in a way that actually sticks? That's what this video is about, and I promise you, by the end of it, you're going to feel a lot less behind than you think you are right now. Here's the thing that nobody in the financial space wants to admit out loud. The biggest reason people don't invest isn't because they're lazy. It isn't because they don't care about their future. It isn't even because they don't have the money, though that's real too. The biggest reason people don't invest is because the whole conversation around investing has been designed, intentionally or not, to make average people feel like they've already lost. Think about how this topic is usually presented. You need to start in your 20s. You need to max out your retirement accounts every single year. You need to understand expense ratios, asset allocation, rebalancing, tax loss harvesting. And if you don't, well, good luck. The message underneath all of that is this is complicated. You probably got here too late, and the people who are going to be fine are the ones who were already doing all of this years ago. And what happens to most people when they feel like they've already lost? They do nothing. Not because they're giving up, but because the brain, under that kind of pressure, just shuts down. There's actually a name for this in behavioral psychology. It's called decision paralysis. When a choice feels too big, too consequential, and too confusing all at once, the brain's default response isn't to try harder, it's to delay, to wait until you know more, until you have more, until the timing feels more right. And that's the trap, because the right time never arrives. There's always another bill, another month where things are tight, another reason to wait just a little longer. And before you know it, you've spent 5 years meaning to get started, which is somehow worse than just never thinking about it at all, because now you're carrying the guilt of knowing you wanted to and didn't. So let me offer you a completely different starting point. Forget everything about what you should have done. Forget the people who started at 22. Forget the charts that show you what $1 million could look like if you just invested $200 a month for the last 20 years. That information is not useful to you right now. What is useful is this. The math of investing doesn't care when you start. It only cares that you do. And $100? $100 is a more powerful starting point than most people realize, not because of the amount, but because of what it represents and what it trains your brain to do over time. Let me tell you about a woman I'll call Maria. She's 41. She works in healthcare administration. She makes decent money, not incredible money, but enough. She's been meaning to get serious about investing for probably the last 8 years, but there was always something in the way. Her kids' school fees, a car that needed fixing, a few months of really rough expenses after her mom got sick. Life, basically. One evening, Maria does something she's never done before. She doesn't read a financial book, she doesn't take a course, she doesn't open a complicated brokerage account with 17 different options she doesn't understand. She simply sets up an automatic transfer, $100 on the first of every month into a simple, low-cost index fund. She doesn't watch it, she doesn't check it every week, she just lets it go. Now, here's where the storytelling usually goes wrong. Most financial videos at this point would show you a big, dramatic chart. Look, at 7% annual returns in 20 years, that $100 becomes... And yes, I'll get to the math, but I want to start somewhere else. I want to start with what happens inside Maria's head over the next 90 days. Something shifts, not dramatically, not overnight, but gradually, the way the light changes in a room when a cloud passes. She starts noticing things she didn't before, not because she's suddenly obsessed with money, but because she's claimed a tiny piece of her financial life for herself. She starts thinking twice before an impulse buy, not out of deprivation, but out of a quiet, growing sense of ownership. She's not doing this for some abstract future self she can barely imagine. She's doing it because it makes her feel, for maybe the first time in years, like she's on her own side. That feeling, that is worth more than the math. Because the math only works if the habit survives, and habits only survive when they're attached to something emotional, not just logical. Humans don't do things consistently because they've calculated that they should. They do things consistently because the act of doing it feels like part of who they are. This is the psychology of identity-based habits, a concept that the researcher and author James Clear wrote about extensively. When you start investing $100 a month and you keep it up, you don't just become someone who invests, you become someone who is an investor. And that identity shift, small as it sounds, changes the decisions you make downstream without you even consciously trying. Now, let's do a little math, and I promise to make it actually interesting. If Maria starts at 41 and invests $100 every single month into a broad market index fund, and that fund returns 7% annual returns, which, by the way, is a conservative estimate based on long historical averages, here's what she's looking at. After 10 years, she's put in $12,000 of her own money, but her account is worth somewhere around $17,000. After 20 years, she's contributed $24,000. The account, somewhere around $52,000. That gap between what she put in and what she has, that gap is time doing the heavy lifting for her. That is compounding. And compounding doesn't care that she started at 41 instead of 21. It just needs time to work, and it starts working on the very first dollar on the very first day. Now, I want to be really honest with you here. $52,000 in 20 years is not retire in the Maldives money. I'm not going to pretend that $100 a month is going to replace a 40-year career of saving. But here's what it is. It is a foundation. It is proof of concept. It is the thing that once you see it growing, it makes you want to put in 125, then 150, then in a year when things go well, maybe 200. The number grows because the habit grows, and the habit grows because the identity deepens. And this brings me to something I really want you to understand about index funds specifically, because if you're new to all of this, the word investing probably conjures images of traders in suits watching numbers flash on screens, and that world has nothing to do with what I'm describing here. An index fund is essentially a basket that holds a little piece of a lot of different companies, hundreds, sometimes thousands of them all at once. When you buy into an index fund, you're not betting on one company doing well. You're betting on the entire economy continuing to grow over time, which historically it has. Not every year, not in a straight line. There will be years when the market drops and your account is worth less than what you put in. That is normal. That is not a reason to stop. That is in fact one of the best times to keep going because you're buying more shares at a lower price, which means when the market recovers, and it historically always has, you benefit more. This is what's called dollar cost averaging. You don't try to time the market. You just show up every month, put in your $100, and let the market's natural ups and downs work in your favor over time. It is genuinely one of the most elegant, low-effort strategies that exists and requires almost no financial expertise to execute. There are a few types of index funds worth knowing about. Broad market funds, like those tracking the S&P 500 or the total stock market, are the most common starting point. They're widely available, typically have very low fees, and long track records. There are also international funds if you want exposure outside your home country, and bond funds, which are less exciting but more stable, and which become more relevant as you get older and want to reduce risk. But if you're just starting, one broad low-cost index fund is enough. Seriously, you don't need to build a complex portfolio on day one. You need to build a habit on day one. I want to step back for a second from the mechanics and talk about something that I think is more important than any of this, and it's something that financial education almost never touches. Why does money feel so heavy? Not in a budgeting sense, but emotionally. Why does the topic of investing specifically carry this particular flavor of shame, of dread, of "I'll deal with this later" avoidance? I've thought about this a lot, and I think it comes down to one core belief that most of us carry without even knowing it, that financial success is a reflection of your worth as a person, that if you're not in a great financial position, it means you made bad choices, or you weren't disciplined enough, or you didn't value your future self the way you should have. And that belief, that deeply personal, often unconscious belief, is what makes the whole subject feel so loaded. Because it's not really about money anymore. It's about whether you're the kind of person who has your life together. And when the stakes feel that high, of course you avoid it. Of course you change the subject. Of course you spend Sunday night doing anything other than looking at your bank account. Here's the reframe I want to offer you. Your financial situation right now is not a verdict on your character. It is a set of circumstances shaped by your income, your expenses, your family history, your mental health, your opportunities, and yes, your choices. But choices made by a person who was doing the best they could with what they had and what they knew. That's it. It is not a life sentence, and it is not the whole story. The most powerful financial decision is the one that reconnects you to hope, because without hope, there is no action, and without action, nothing changes. The $100 Habit is an act of hope. It's small enough to be real, but meaningful enough to matter. And here's the thing about hope. It's not a feeling that arrives before you act. It arrives because you acted. You don't feel hopeful and then start. You start, and then, slowly, something that feels a little like hope shows up. I've talked to people who've been doing this for just 6 months. Just 6 months of a small, automatic monthly investment. And the most common thing they say is not, "Look how much money I made." It's something quieter than that. It's, "I feel like I'm finally doing something. Like I'm not just letting life happen to me anymore." That shift from passenger to participant in your own financial life, that's the real turning point. And it doesn't require a perfect budget or a financial advisor or a certain income level. It requires one decision made once, automated, and then trusted. There's another dimension to this that I think matters a lot in 2026 specifically. The economic environment right now is confusing, honestly. Inflation has done a number on people's savings. Interest rates have been all over the place. The news cycle around money is relentlessly anxious and contradictory. And in that environment, the temptation is to wait for things to stabilize, to wait until you really understand what's happening in the market, to wait until it feels safe. But the market is never going to feel safe. That's not how it works. And waiting for safety is, functionally, the same as not starting. The people who build wealth through slow, consistent investing are not people who figured out the right time. They're people who decided time in the market, any time, including uncertain times, is more valuable than timing the market. And $100 a month riding through the uncertainty with you is evidence of that belief made real. All right, let's get practical, because I don't want you to finish this video feeling inspired and then do nothing. That is the worst outcome. So let me walk you through exactly what this looks like in real life, not in an ideal scenario, but in a real one. Step 1 is the simplest and most important. Automate it. Do not rely on yourself to remember to invest each month. Do not make it a decision you have to make again every month, because some months you will talk yourself out of it. Set up an automatic transfer on a date that works with your pay cycle, ideally the day after you get paid, so the money moves before your brain decides it needs it for something else. This is sometimes called paying yourself first, and it works not because it's clever, but because it removes the need for willpower, which is our most exhaustible resource. Step 2, choose simplicity over optimization. If you're in the Philippines, which a lot of our viewers are, you have access to several platforms that allow you to invest in low-cost index-style funds or equity funds without needing a large minimum. COL Financial, Atrum, and similar platforms have made retail investing far more accessible than it was even 5 years ago. If you're elsewhere, the options multiply. The key is not to find the perfect fund. The key is to find a reputable, low-fee, broadly diversified fund and start. You can optimize later. Right now, you just need to start. Step 3, protect the habit from yourself. There will be a month, maybe in 3 months, maybe in 6, where something comes up and you'll think about pausing the automatic transfer just for this 1 month. I want you to really think carefully before doing that. Not because the money is the most important thing, but because the habit is the most important thing. If you absolutely must redirect funds for a genuine emergency, and real emergencies are real, that's okay. But if it's an impulse or a comfort purchase dressed up as a necessity, try to let the transfer run and find the money elsewhere. The habit is the asset. Protect it like one. Step 4. Don't look at it obsessively. This one feels counterintuitive, but it's crucial. Checking your investment account every day or even every week in the early months is a fast track to anxiety. Markets fluctuate. Your account will go down sometimes. If you're watching it constantly, you will feel things: fear, regret, the urge to do something. And doing something impulsively is almost always worse than doing nothing. Set up a quarterly check-in reminder. That's it. Look at it 4 times a year, note where you are, and move on with your life. Step 5, and this is the one that turns a habit into a journey. Increase slowly over time. Once the $100 habit feels normal, and it will, usually within 3 to 6 months, consider whether you can push it to 125. Not a dramatic increase, not a lifestyle overhaul, just a quiet, steady upward drift. You don't have to decide that now, but keep it in the back of your mind as a possibility. Because the real magic of this habit isn't the $100, it's the direction it's pointed in. And over time, habits tend to grow in the direction they're pointed. One more thing I want to address, because I know it's on some of your minds right now. What if I genuinely don't have $100? What if after rent and food and utilities and everything else, there is truly nothing left over? Then start with 50, start with 25, start with whatever number when you look at your bank account after your bills are paid feels like you can do it without going backwards. The number matters far less than the act. Even $20 a month is proof that you're an investor. Even $20 a month starts the identity shift, and identity shifts over time change behavior in ways that $20 alone never could. I want to close with something a little more personal. Not advice, just a thought I keep coming back to. There is a version of you, the one sitting there right now, maybe a little tired, maybe carrying more than most people know, who has been told in 100 different ways that the window has closed, that financial security is for people who started earlier, who earned more, who made better choices at 22. And I understand why that message has gotten in. It's loud, it's everywhere, and there's just enough truth in it to make it sting. But here's what I know to be true, and what I want you to carry with you after this video ends. Every person who has ever built something financially stable built it one small decision at a time. Not in a single heroic moment of discipline, not from a place of perfect clarity and zero doubt. They built it quietly, imperfectly, in the in-between moments of an ordinary life. While the kids were doing homework, while the rent was due, while the economy was uncertain and the news was terrifying, and the future felt genuinely hard to look at. They built it because they kept going, not because they started perfectly. The most important financial year of your life isn't the one when everything lines up. It's the one when you decide to stop waiting for everything to line up. This is 2026. Maybe you're reading this at 38 or 45 or 52. Maybe you've had some hard years financially. Maybe you're just now getting stable enough to even think about this. That's okay. It's more than okay. Because the version of you who is thinking about this, who watched this entire video, who is sitting here genuinely considering what $100 a month could look like, that version of you is already ahead of where you were an hour ago. And that counts. That really, genuinely counts. Start small. Start now. Not because it guarantees anything, I'll never tell you that, but because you deserve to have something that's yours. Something growing quietly in the background of your life. Something that 5 years from now you will look at and think, I'm glad I started. That's the whole thing. That's the whole video. Be patient with yourself. Be consistent when you can. And remember, progress always beats perfection, especially when perfection was never an option in the first place. Thank you for spending this time with me. If something in this video landed for you, share it with someone you think might need to hear it. And if you're ready to talk about what comes next, how to grow that habit, how to think about retirement if you're starting later, how to actually feel less anxious about money as a whole, there's a lot more where this came from. Take care of yourself. I'll see you in the next one.